Welcome to the new IFRS 17 Insurance Contracts webcast on Level of Aggregation, Part 2. This webcast is part of the series that the International Accounting Standards Board is producing to support the implementation of the new Insurance Contract Standard. My name is Laura Kennedy and I am an Assistant Technical Manager on the Insurance Contracts project.
My name is Joanna Yeo and I'm a Senior Technical Manager on the Insurance Contracts project.
Before we start, as usual, the views expressed in this presentation are our own and not necessarily those of the International Accounting Standards Board or of the IFRS Foundation. A copy of the slides used in this presentation is available for download via the website. Those slides are accompanied by additional materials that we hope you will find useful. In the previous Level of Aggregation webcast, Part 1, we covered why and how insurance contracts are grouped. In this webcast, Part 2, we will cover the recognition and derecognition of groups, as well as how groups feature in the disclosure requirements. We recommend listening to Part 1 before listening to this webcast.
Let's start with discussing the recognition and derecognition of a group of contracts. You may also be interested in our previously released webcast on recognition and derecognition available on our website. The information in this webcast complements the requirements discussed in that earlier webcast. So when is the initial recognition for a group? As a reminder, a group is recognized on the earliest date of the beginning of the coverage period for the group, that is, being the beginning of the coverage period for the first contract to join the group, or when the first payment becomes due from a policyholder in the group. If there is no contractual due date for the first payment, it is presumed to be due when it is received, or when a group of contracts becomes onerous. As previously touched upon in Part 1, groups of insurance contracts are established at initial recognition, and those groups are not reassessed subsequently. After a group is recognized, qualifying contracts issued no later than a year from that date can be added to an existing group. This is something we will cover in more detail in the next slide. Some groups of insurance contracts, all contracts in the group, may be recognized on the same day, the initial recognition of the group. An example of this could be on the purchase of a closed book of business. However, in general, contracts in a group will be issued over a period of time. The entity will include contracts issued no more than 1 year apart in a group. That time period does not need to align with the entity's reporting period. On initial recognition of the group, the fulfillment cash flows, contractual service margin or loss components, discount rates, and number of coverage units will be determined based on the contracts in the group at initial recognition. The entity does not include in its estimates any contracts belonging to the group that have not yet been issued and recognized. When contracts join a group that has already been recognized, these assessments will be adjusted prospectively to take into account the contracts that have newly joined the group. That is, the entity will prospectively for the group adjust the fulfillment cash flows, adjust the contractual service margin or loss component, revise the discount rates at initial recognition that will be applied subsequently. The entity will need to know the discount rate at initial recognition to apply specified requirements subsequently. Revise the number of coverage units, reflecting in the quantity of benefits to be provided by the group. Accordingly, if the period of contracts joining the group straddles 2 or more reporting periods, at the end of each reporting period, the measurement of the group will include all qualifying recognized contracts up to and including the reporting date.
We We have just covered contracts joining a group over time. Similarly, contracts belonging to a group may be derecognized at different times. A group of insurance contracts is derecognized when the last contract in the group expires. When a contract is derecognized before the group is derecognized, an entity should eliminate the fulfillment cash flows for those contracts that have expired and adjust the number of coverage units remaining. The next slide provides a reminder of when a contract is derecognized. An entity derecognizes an insurance contract when all rights and obligations arising from that contract are extinguished. At this point, there is nothing left to measure. When are the rights and obligations extinguished? They are extinguished when the obligation has expired, been discharged, or cancelled. However, an entity cannot derecognize the insurance contracts simply because it has purchased reinsurance contracts. An entity will also derecognize an insurance contract when the terms are modified in a particular way. An example of when terms are modified is when there is a change agreed between the parties of the contract, or as a result of a change in regulation. Sometimes an insurance contract has options as part of its original terms. Exercising an option already included in a contract is not a modification. You may be interested in our previously recorded webcast on recognition and derecognition available on our website.
The final topic we will cover briefly is disclosures. Applying IFRS 17, an entity shall consider the level of discount necessary to satisfy the disclosure objective, which is to disclose information in the notes that, together with the primary financial statement, gives a basis for users of the financial statements to assess the effect that insurance contracts have on the entity's financial performance, financial position, and cash flows. This follows the usual disclosure principles. Disclosure information should be aggregated at a level so that useful information is not obscured. Useful information can be obscured by being too detailed and granular or by being too high level. The entity need not provide separate disclosures for each group of contracts or each portfolio. Examples of aggregation bases that may be appropriate for insurance contracts are by type of contract, such as product lines, by country or region, or by business reporting segment. IFRS 17 requires disclosures to provide a reconciliation of the movements in insurance contracts over the reporting period. In addition, IFRS 17 requires separate opening and closing balances of this reconciliation when a group or group of assets are assets and a group or group of contracts are liabilities.
That's the end of this webcast, Level of Aggregation, Part 2. We hope that you found it useful. As stated before, we intend to produce future webcasts and other materials to support the implementation of IFRS 17. Thank you for listening to today's webcast.
Thank you and goodbye.